Well, good afternoon, ladies and gentlemen. Welcome to the first Seven Investment Management teleconference for 2012, and thanks for joining us this afternoon. Our aim today is to spend the next half hour or so going through our latest asset allocation views following our most recent asset allocation team meeting. I'm joined today by Ros Price, our Chief Investment Officer. Hey, Ros.
Hi.
And also her number two, Senior Investment Manager, Alex Scott.
Hello.
First of all, if I may, let's start with the global economy and most recently sort of how we got to the position we're into now. Let me, I suppose, first set the scene, and forgive me for hogging the start, because I think we have to try and negate all the appalling news that seems to have been continuously pumped out by our chums at the media. I can quite understand how anyone over the holiday, both watching and listening to all the news, would quite easily have come to the conclusion that the global economy is falling apart and the sky is about to fall in. Well, it may be unfashionable in the media world, but in fact the global economy is doing, well, quite well. It's still growing, albeit lower and slower, but at least it's still growing at quite a respectable rate. Yes, there are some key issues to address, and maybe all of the bad news is being overdone, and to an extent much of it may be already be in the markets and in the price. So, these are vital questions for my two colleagues, but also for all of us. So, Ros, if I may start with you, what actually happened in 2011 and how do we get to our current position?
Well, markets actually began last year on a relatively positive note. Company earnings were looking quite strong, inflation wasn't a problem, and everything looked okay. There were problems in Greece rumbling on in the background, but we were used to that. Then, of course, came the Japan earthquake, and then the tsunami on top of that, which caused a lot of problems in the global supply chain. Things started to go wrong from there. Also, markets began to be rather harder in how they viewed what was going on in the Eurozone. And finally, in July, I think what really happened was, despite the positive European summit meeting, which looked as if it was setting off down the road to solve the problem, and they'd managed to kick the Eurozone problem into touch once again to allow time for banks and countries to work out their problems, we came up to the US debt ceiling limit talks and their failure. Now, most people had discussed this for some little time over the course of the summer. It was entirely expected. But markets behaved as if it wasn't. And on top of that, of course, you had the Standard & Poor's downgrade of the US debt from AAA to AA+.
But you've been relatively positive up until that stage, but you were worried that the things were going to turn round, but not then.
We were. We expected a good reporting season for the second quarter earnings in the US, and we were looking to get that underway and take profits. Unfortunately, the market turned round and fell almost cataclysmically at the end of July, beginning of August, before we could take those steps. And at the same time, because we felt fixed interest was overvalued, we had not enough fixed interest.
So just those 4 days alone, really, at the beginning of August, that caught everything by surprise on it. So, Alex, how did the 7IM portfolios perform in the year?
Well, it was a tough year for us. We were able to recover some ground in the fourth quarter of the year as markets finished the year reasonably strongly, but the scale of that correction in August meant that it was a year of some underperformance for us and unfortunately of losses for the year for most of our portfolios.
So what actions have we taken in the portfolio since then?
Well, we've been quite active. We've looked to make sure that we've got a larger than usual cash cushion in portfolios, both to make sure that we've got a buffer against volatility, but also to make sure we've got enough liquid resources in the portfolios that, as opportunities come in volatile markets, that we're well placed to take advantage of those. And in fact, we have been able to take advantage of some such opportunities. For example, in corporate credit markets, where we've been able to buy both high yield and investment grade debt at good prices over the last few months, and also more recently where we've started to add to US equity positions.
Another question I've just had in, which was, how do we best assess whether your funds, 7IM funds, have met their objectives, and how do we manage client expectations? And I suppose we can preface this by sort of saying the first thing is we don't take a short-term view, we take a longer-term view. So how has that actually played out?
Absolutely. I think the long term is vital. I mean, the long-term projections that we make and that we review annually for each of our risk profiles and the strategic asset allocations that go into making those are absolutely vital. So I think the question is, are our funds performing within the range of expected returns for the various risk profiles over sensible investment time horizons?
Well, I've got sort of 3 years. The balanced 7-iron balanced fund was about 21%, and the passive AAP one 21.8%. So yes, that's actually sort of what you expected, wasn't it?
Very much so. I mean, on a 3-year view, that's a little over 6.5% a year, 6.7% a year. Very much in line with the long-term investment return projections that we make.
And after costs with all of that. Now, Alex, I remember when you put together your extremely comprehensive asset allocation papers you prepared that I have to read the weekend before our meeting. It ruins my weekend. What did you come out with your scenarios this time?
Well, we had 3 main scenarios going into the December meeting. I think fairly low probability for a very optimistic scenario, a sort of best of all possible world scenario with a quick resolution to some of the Eurozone problems and strong growth from outside the developing world. We put about a 10% possibility on that scenario. We had a 20% probability on a calamity scenario. That's a sort of scenario where the Eurozone goes into a chaotic, disorderly breakup with widespread defaults, with problems throughout the banking system, and a risk of very serious, very deep recession in that sort of scenario. But as I say, only a 20% probability of that. By far our most highly weighted scenario we call the hard slog. So that's a scenario with a background of very subdued economic growth in the developed world, but still growth, still an environment in which corporate earnings can rise, and an environment in which the destination's marked for the Eurozone, and that's a destination of much deeper integration in the Eurozone. Sure, setbacks along the road towards that destination, but I think with policymakers very much in control and marking out which direction we're going in.
So if it's 20% disaster, I think you can turn that around as being 80% not disaster. So take a slightly more positive element on it.
Yeah, I think that's right. And the issue perhaps that we faced at some times during 2011 was that the market was perhaps putting a higher probability on that disaster outcome, and clearly that had a big impact on asset prices.
Okay, now let's move on and take a swift tour around the globe and look at some of the key issues. Ros, Europe, your holiday destination of choice. The future of the euro, does it have one?
Yes, of course it does. We do not believe that the euro is heading for demise at all. We think that, as Alex has just pointed out, there will be a deeper integration on a fiscal level for Europe. We will get not a United States of Europe in the next 5 years, but probably in the next 50 years we will have done. And I think that's probably the right solution.
And Mrs. Merkel's trying to bring forward proposals
it is,
now, isn't
indeed. I think also we can look for a recession in Europe, certainly in the first quarter. But one of the things that Angela Merkel has said before Christmas, not remarked at all in the press here, that she is looking at ways to stimulate growth within the Eurozone, knowing that you cannot just survive on cutting the rather excessive debt some countries have. And I think that she's looking at there being a good background for European companies to still operate. Obviously, the banks and the banking system have been one of the great issues there. The ECB has dealt with that. In September, a very little remarked policy was to change the types of collateral that banks can place with the ECB in order to borrow money. And then they brought in these massive tenders where banks can borrow for up to three years at a low price, 1% or lower, as low as they like, as much as they like, for as long as they like. There's another one of these in February.
So the plumbing of the banking system would seem to be secure then?
Shouldn't be leaking anywhere now, no, that's quite right.
So with all of this, therefore, I mean, last year we were saying, you pointed out to me on several occasions that you had corporate results in the Eurozone actually doing quite well, but it was the political issues that were actually hampering any particular movement in the markets.
It was, and I'm not sure it's the actual political issues, but the market's perception of them. There seems in the Anglo-Saxon media to be a death wish for the euro. They would like it to die because it makes for better headlines, but it isn't going to do that. And I think that companies such as BMW are exporting to China and to the rest of Asia, and they've had record years.
Okay, another question I've had in, which is, if we get a sovereign default in one of these Eurozone states, like Greece or Portugal, how much of this is currently priced into the markets?
I would say most of it is in. If you had something, and remember we're talking here about a default, which means that they are repudiating their debts rather than a breakup in the euro and the Eurozone. I think most of that is already in the price. It's probably also in the bond yields as well as the equity market prices. You might see a little frisson in the market, maybe, and we would see, say, Europe on that type of situation would be maybe down another 10% from where it started this year, in this quarter. But we actually do see the market being up by the year end.
Okay, thank you. And now, Alex, let's move on to the US. And again, some of the headlines being pretty murky there, but underneath that, actually some quite encouraging trend figures coming through.
Yeah, well, I think the market's fears of a double-dip recession in the US that surfaced last summer looking unfounded at the moment. The US certainly proving more resilient than those fears suggested. We're seeing improvements in the labour market. We've seen signs of strong demand picking up again for consumer credit. We're seeing the housing market perhaps starting to stabilise in the US. So I think in terms of growth there, in terms of the ability of companies to generate earnings and support their dividends, it's a reasonably resilient situation for the time being.
But we still have, obviously, the issue of the election coming up this year. So really, isn't the problem just going to be delayed till 2030?
Yeah, well, clearly, it's a long road yet to that election, but absolutely, the next administration is going to face huge challenges on bringing the budget in the US under control. But I think they do have time at the moment. The bond market is clearly taking a reasonably relaxed position about the US at the moment, with borrowing costs and bond yields for the US running at very, very low levels. That has to be watched. If we see yields rising significantly in the US, then that could pose a challenge. But for the time being, I think a reasonably resilient situation and one that we're happy to feature in portfolios.
And we're just at the start of the corporate earnings season coming through, and the outlook here again doesn't seem to be that bad.
Yeah, clearly we can't judge on the first day or so of the reporting season. It's early days yet, but forecasts are for continued earnings growth in the US corporate sector, and that earnings growth helping to underpin dividends. So from that point of view, I think whilst growth is coming through and perhaps some surprises to the upside, I think the outlook looks reasonable for US corporate earnings.
Okay, let's move on to the developing nations. I mean, and here, Ros, you were warning us last year that yes, have exposure, but don't go overweight in these areas. So let's I suppose start with China. Is it a bubble, and is it going to be a hard landing?
I don't think there'll be a really hard landing in China, and I think that they're already taking steps to avoid that by loosening monetary policy, and the property market has actually calmed down. Although I would say I've been reading forecasts for the housing market in China to see house price falls of anything up to 20% in 2012. The big question over China, of course, is the leadership change that is due at the end of next year. While we know the names for the top two posts, what we don't know are who is going to succeed in the race for the next layer down of posts, and which are in many respects more important for the day-to-day governance of China. And some of the names that are coming to the fore from some of my reading would appear to be rather Maoist in their tendencies. So it will be interesting to see how such people would blend in with the current pragmatism and the economic growth plans that are in China.
So the two wings here, and the pragmatists would certainly be looking to try and actually push through a recovery package.
I think they would, because one of the things that they really are keen on is making sure that there are no more food riots, and there have been a lot of food riots in China in the early part of last year and the end of the previous year. There have been strikes and things like that, and the last thing that the Communist Party want to see is unrest, civil unrest, and that is quite key in their economic policy. But don't forget that markets look ahead, so they will be looking through this year's political changes and the jockeying for position and the monetary loosening to an improved economy next year. So it is possible that we may have seen the bottom now in the Chinese equity markets already.
And just briefly, do you want to mention something about India? Because obviously there have been some concerns there.
The Indian economy looks to have more problems and more mountains to climb than most of the others in the Asian region. And we are still very wary of investing in India because there doesn't seem to be a concerted policy attack on what to do.
Okay, let's move on. UK, Alex, here austerity continues.
Yeah, I'm afraid it does. I mean, I think the Chancellor and the government are very focused on doing what they can to keep the UK's strong credit rating and keep low borrowing costs for the UK. So that does likely mean continuation of austerity. But I think we're still in a situation where the UK can avoid recession. There is enough growth coming through in the private sector. But clearly the outcome for our trading partners in the Eurozone is incredibly important for us. If Europe's able to avoid the worst case scenarios, then I think that's reasonably good news for the UK. On the other hand, if we see those high risk scenarios playing out in a Eurozone catastrophe, then we're very exposed to that.
And how does this translate into for the UK? Because obviously we've got the FTSE 100, which is a UK index. It doesn't actually reflect much of what's happened in the UK, though, does it?
No, to a large extent, the FTSE 100 reflects global multinational companies. So, and particularly over the last few years, with a change in the character of a lot of new listings coming to that market in the form of international mining groups and the like. So I think it's important to recognise that the UK equities are not necessarily a direct reflection of UK growth. We're certainly able to look at good quality companies there with good earnings and good dividends.
Right, let's see how this translates now into portfolios and what we do from here. Let's start off with cash. Ros, what's the situation there?
We are slightly concerned in this quarter, maybe for the first third of the year, that there is risk and we'll see more market turbulence and volatility. So we are carrying a slightly heavier level of cash than we would normally do, partly so that we can pick up situations at lows.
Right, so you'll see some more volatility which you'll use to buy in.
We will.
Okay. Alex, in terms of equities?
Well, we're taking a reasonably careful position with our equities. We've pulled back target allocations to around neutral against our strategic weightings. But I think what's an important factor for us is some of the regional differences within that, and particularly looking to try and favour or put a tilt on towards US equity markets within that.
Large caps?
Yes, absolutely. I mean, the large cap multinational companies with resilient business models and good potential for dividend growth are a key part of that.
Dividends and, Ros is always reminding me of the power of compounding of dividends and interest. And certainly we're seeing some very good yields now.
Absolutely. So dividend yields in equity markets clearly well above those that were well above the income yields that we see in bond markets. That's a key attraction. And of course, one of the other themes that we've been looking to play is not just buying companies for their dividend yield, but looking to isolate the dividend strips themselves and buy those dividend strips over the next few years, which appear very cheaply valued by markets.
And so in terms of weighting this, US and Europe we stay clear of, or
Europe, we have an underweight allocation at the moment, and we're hedging most of our euro currency exposure still at the moment. The US is one of our more favoured equity markets around the world.
And underweight the developing nations as well?
Absolutely.
Okay. Ros, fixed. This is obviously one of the more controversial issues of last year.
Yes, in the safe haven markets, we feel that yields now are at levels that are not terribly attractive to buy into, but we expect those yields to continue low as central banks keep interest rates at close to zero for some little time, probably until 2014. There are, of course, those countries in the Eurozone which are offering yields over 7%, and whilst we're not rushing out to look at Greece particularly, time is going to come when I think we may well buy some Italy or some Spain, because those are attractive yields if the problems are being solved.
That's on the sovereign side. What about on the corporate side?
The corporate side, we see very attractive opportunities in global corporates and UK corporates, as well as high yield, and we have already actually taken steps in the latter part of last year to buy into those markets.
Okay, just some of the other areas then. Let's talk about currencies briefly. Alex, in terms of the dollar?
The dollar, we think, has got potentially quite a powerful role to play in portfolios, partly as a natural risk hedge for investors. What we tend to see at the moment with particularly markets when they are under pressure, they're under pressure because of the Eurozone crisis, we're tending to see the dollar favoured as a safe haven at that point. So making sure that we've got reasonably high exposure to the US dollar in our portfolios, we think helps to control overall volatility. And I think also, whilst we're seeing the US economy outperforming some of the other developed market economies, that's also pretty much a dollar positive factor. So we quite like the dollar. We hold considerable exposure to that.
And are we going to hedge the other currencies, keep it all neutral? Then?
We're hedging most of our euro exposure at the moment. The yen is fairly small for us, but we're hedging a significant proportion of Japanese yen exposure as well.
Okay, let's briefly go through some of the alternatives. Property, we've been pretty negative on that for some time.
Yeah, we cut UK property weightings during the second half of last year. I think UK property or UK REITs certainly have underperformed the broader equity market since then. We stay cautious. I mean, the UK economy likely still to be growing, but I think not growing particularly strongly, and I'm not sure yields in property markets are quite high enough to compensate for that.
Okay, and commodities, both softs and metals?
Again, fairly low allocations to those areas. I mean, I think we're looking at an asset in the shape of commodities that is geared to the economic cycle to some degree, and I think if we're looking for those more cyclical assets, then possibly we're preferring equities with their yields, their positive yields, as a first step back in when we're ready to take on more risk in portfolios.
And would the same apply to gold?
Well, I think gold is always a slightly special case. I think as markets are looking at prospects for more QE, more quantitative easing over the course of this year, there is potential for gold to drift higher. But I think whilst we're also in an environment of relatively strong dollar, that's a counterweight that can help to hold gold back. So yes, we hold some weightings, but we're not getting carried away on gold.
Okay, and then if I can bunch together the hedge and CTAs as well. The managed futures. Yeah,
well, I think hedge funds as an asset class or as an industry have been disappointing on the whole through last year. We saw too many funds, too many managers cutting back risk significantly at the wrong moment. I think we're doing slightly better with our approach of trying to exploit the discounts in the listed closed-end hedge fund market, where we've seen a lot of activity. And we're continuing to build as well in the CTAs or managed futures, which certainly over time have shown very low correlations to other asset classes, and therefore quite a powerful tool in controlling overall portfolio volatility.
And private equity, I was going to mention as well.
Yeah, it's a difficult area. I think there's a lot of value in some of the private equity listed private equity vehicles that are out there, but pretty poor liquidity on the whole tends to have quite high correlation to equity markets. So I think whilst we're looking to take quite a careful approach on risk in portfolios, it's right to be cutting back allocations to private equity where the opportunities are there. But we still want to be able to exploit some of those situations in portfolios that have got a higher tolerance for risk.
Okay, so overall, there may be sort of leaden clouds around, but there certainly are shafts of light, which might even, with a bit of luck, turn into a sunny period occasionally. A couple of other points questions I've had in, which I think are sort of nice and clear, which is, what opportunities can you see ahead and why? Where are the positives we should be looking for this year?
Well, I think we're all well aware in markets, and well, anybody in touch with watching the media in the UK, we're all very well aware of the threats. I think it is absolutely vital to keep an eye on the opportunities, and I think those are coming through in valuations for some long-term assets related to the corporate sector. So essentially we are talking corporate bonds, whether it's high yield or whether it's investment grade corporate bonds, where pricing has been marked down and where very good yields can be had. And for long-term investors and certainly those who can look through volatility, I think we should be looking for opportunities to take advantage. But I think we've got to be very mindful of the risks of volatility over the next few months and play that carefully.
Okay, and I suppose the other half to that question is what are the threats we can see ahead? Obviously, the obvious ones that have been highlighted in the past few weeks, such as missiles in the Straits of Hormuz and such like. Ros, where are your horror stories?
I think some of my horror stories will probably come from the US, where we get some rather difficult result at the end of the presidential election period, that we get someone that we don't understand and whose policies could be a little idiosyncratic, should we say. That's one of the ones that keeps me mostly awake at night, because whilst the US budget deficit is not a problem for now, in the next 2 to 3 years, it is going to be a big problem, and we'll all pay for that. Otherwise, they are geopolitical. I worry about Russia and what will happen there, and I worry about the change of leadership in China.
And that's apart from anything that might happen in the Middle East as well, I suppose.
Well, yes.
And one last question I've got here, which is, how are you, Seb and I am, uniquely positioned to mitigate client risk and maximise potential returns in the coming months? Alex, how would you answer that?
Well, I think our investment process is designed specifically to try and do that. And that's the layers of structure that we have. So the robust strategic asset allocation that we try to build across a wide, diversified range of asset classes, that where we're reviewing the likely risks, returns and correlations of those asset classes using long-term data every year, making sure that assumptions are still valid and that the mix of assets is still likely to do the job that it's intended to do. And then I think on top of that, the experienced committee that we've been able to put together to help us drive tactical asset allocation in portfolios, where we're specifically looking to adjust those portfolios in the face of risks that emerge and in the face of opportunities that come up as well.
And add to that, I think it's important is being able to strip out some of the extra costs and charges we've seen in our industry to make it as clear and transparent to people of the value they really are getting as well. Okay, well that just about brings us to the end of our half-hour slot. So thanks Ros and thanks Alex for your time. And if anybody would like to have a copy of our asset allocation views, do email us directly or through your usual Seven Investment Management contact, and we'd be delighted to send them out to you immediately. I'd also personally very much appreciate any comments you may have had on our commentary today, and any ideas you may have and thoughts of what we might be able to do in the future to try and improve these briefings for you. And also, can I thank you for your time today and take this opportunity to wish you every success this year and wish you a very prosperous new year. Thank you very much indeed. Goodbye.